Hello learner, welcome to Manifested e-learning platform. My name is Emlyn James Ngwiri and I'll be taking you through equity investment analysis. And this topic that we'll be looking at today will be the equity valuation process. Equity valuation process. This is lesson 3, and what we had looked at in lesson 1 and lesson 2 have been summarized here. So in lesson 1, we looked at the definitions of value. Which include, we looked at the intrinsic value, we looked at going concern, and liquidation value. We also looked at investment value, the investment value there. We went ahead, still under lesson 1, to look at the applications of equity valuation. So we looked at applications of equity valuation. There. So that is what we looked at in lesson 1. In lesson 2, we looked at lesson 2. We looked at the market capitalization. There. And how to compute or how to value speculative stocks, valuation of speculative stocks. As well, we also went ahead and provided some useful insights that relate to the equity valuation process, which include the shareholder value. Value there. Now in lesson 3, what are we going to look at? We will look at the equity valuation process, or the steps that are involved in the equity valuation process. And the steps have been abridged here. So we can start with the first step, understanding the business. There, that will be the first step. Then we will move ahead and look at the second step, forecasting company performance. There. The third step will be selecting the appropriate valuation model. Yeah. Then we move ahead and to the fourth step, converting forecasts into valuation. And under the third step over here, what are we going to be looking at? We are going to be looking at the factors that need to be considered in model selection, the factors that need to be considered when selecting a model there. So I'll be able to rightfully place that subtopic under selecting of the appropriate valuation model there. Moving on, applying the valuation conclusions. So these are the steps in the equity valuation process. Understand the business, forecasting company performance, selecting the appropriate valuation model, converting forecast into valuation, then we can be able to apply the valuation conclusions there. 5 steps. After we have covered the equity valuation process, or the steps in equity valuation, we'll move ahead and look at the factors that need to be considered. Factors that need to be considered when writing a research report. When writing a research report. There. We can be able to probably summarize this and say the features more precisely, features of a research report. There. Once we look at that, there, we will now look at the format of a research report. Format of a research report. Once we look at the format of a research report, then we'll be able to conclude our lesson by looking at that final part. So just to begin, or without further ado, let's continue, or let's start off this lesson by looking at equity valuation process. Yes, this is the equity valuation process that I'm talking about, but more specifically, we're looking at the steps. The steps. So step number 1, understanding the business. Before you place any money into the stock market, you need to perform a further or a thorough understanding. You need to have a thorough understanding of the nature of the business that, say, for example, maybe KCB is doing. And we will be able to break down what we need to look at when trying to understand KCB's business. So understanding the business involves conducting an industry. I can wrap this first of all temporarily. And company analysis. That involves conducting an industry and company analysis. What is involved in industry analysis? So A, industry analysis. You need to perform a thorough analysis of the industry companies, of the industry within which the company are trying to conduct the valuation on. So since our example is KCB, you need to try and see which other companies have got assets similar to KCB. We can be able to quote them down. Listed companies. You talk about listed companies, the ones which are listed on the exchange. So the first one is Equity Bank. Another one we can be able to highlight over here as maybe Barclays Bank. And maybe even to add on is Cooperative Bank. This is just a synopsis of what understanding the industry or performing an industry analysis involves. So you try and look at the competitors. This is the key company that you're trying to analyze or to conduct an analysis on. So you need to look at companies which have got similar assets and liabilities. You try and say, okay, these are the companies which have got a similar amount of assets and liabilities. And in industry analysis, or when conducting industry analysis, you need to consider the 5 forces, Porter's 5 forces analysis. So consideration needs to be emphasized, needs to be done rather, on the back of Porter's 5 forces analysis. Now, I will be able to explain the Porter's 5 forces analysis right here. This diagram. These are competitors. Here we have new entrants. This part over here, we have substitutes. We have buyers. And finally, suppliers. Michael Porter came up with 5 forces that need to be considered when conducting an industry analysis. These are the 5 forces. So we can start off by looking at competitors. You can say A, you can put this because that one we've already written as number 1 right over here. We can put this in form of italics like that. You can say that is, or Roman numerals rather. So competitors. There. Inherent industry competition needs to be looked at from the perspective of the key competitors there. So we are trying to analyze KCB based on our example here. So you need to try and analyze, okay, who are the key competitors within the industry? Barclays Bank, there is Equity Bank, and Cooperative Bank. So we put a hyphen and we can write over here and say lower competitors or lower competition within an industry will signify higher profitability. Because we are saying that if you only have 3 competitors or 4 competitors, it is not the same as when you have 10 competitors or 18 competitors there. So these firms will be able to participate or contribute in form of profitable ventures or profit potential there. So with lower competition or with few competitors, it will translate that the possibility of getting higher returns in form of profitability will be enhanced. Number 1. Number 2, we've already done competitors there. Let's look at buyers. With lower buyers within an industry will imply lower profitability for firms within the industry. Fewer customers come and buy the products that you've actually availed. So if you have lower buyers, now we are looking at it from the potential. We are still looking at this example here, but we are saying that, come on this side, if we can use a diagram here. Yes, these are the market players, but with fewer buyers of the products and services, it will mean that the profit potential for these companies existing within the industry will be reduced. And that is why Michael Porter emphasized on these 5 forces. We've already explained 2 of them over here, but these 5 forces, competitors, buyers, suppliers, new entrants, and substitutes, actually contribute towards, or if they're considered and evaluated properly, they can be able to contribute towards inherent profitability for firms. So that is for buyers. Let's move on and look at suppliers. We say with a low number of suppliers existing within an industry will increase the profit, the bargaining power of prices. Enhancing inherent profitability. For farms. So we're saying with lower number of suppliers existing within an industry will increase the bargaining power of prices within the existing industry, and that will translate now to ensuring that the farms that exist within the industry will be able to have significant profit potential there. So that is for suppliers. Now we can be able to now continue and look at new entrants. I can wrap this, or I can maybe just move down over here. The new entrants. Here we are referring to the ability to enter a given industry like this. Now these are the existing players within the industry. If there are restrictions in form of government policy to try and enter the industry, it becomes problematic. It means that the firms that are existing within the industry will be able to have that controlling power of the profits within that industry. If it's the banking industry, for example, like in KCB, if they are given few number of firms which control or have a significant market share, then we are saying that because of the barriers to entry, you must have a lot of money before you can be able to enter the banking industry. That will be able to restrict the profit potential to the players within the industry. So we can say that barriers let's put it like this, to entry within an industry affect profitability of firms positively, implying that they will benefit with restrictions to entry there. So you're restricting firms to enter the industry, so the players within the industry will actually benefit by enhancing the profit potential, because it's very hard to enter the industry there. So that is for new entrants there. If there are imposed government restrictions on entry into a given industry, well, the existing players will be able to benefit profitably there. Finally, we look at substitutes. This was number 4, hadn't indicated there. 4, let's look at now number 5 on this side here. Five is substitutes. With lower substitutes for products, lower substitutes for products and services will imply that firms within an industry will benefit from higher profits, there. So this is the industry exists like that. If there are no substitutes for a given product, it means that the players within the industry, or if there are few substitutes for a product within an industry, it means that these players within the industry will benefit by receiving higher profits or generating high profits with the existing products or services there. Take, for example, a case like sugar. With the existing players, for example, this is the sugar industry, and these players are the players within the sugar industry that exist. So with fewer substitutes, maybe the alternative substitute for sugar is, say, honey there. With fewer substitutes, such as honey being relatively the only substitute for sugar, yes, there is sugar beet and there are other sweeteners which can be able to be used for tea or for other products. But with fewer substitutes, the profit potential for these farms which exist over here will still exist. People will still consume sugar. Yeah. So that is the point that I'm trying to drive home about substitutes. With lower substitutes or fewer substitutes for products and services will imply that farms within the industry will benefit from higher profits. Now we have conducted an industry analysis. We now need to look at the company analysis. We need now to conduct a company analysis by looking at what factors affect or what are the generic strategies that can be able to be considered by firms to try and enhance the profit potential. So we are saying Michael Porter came up with generic strategies that companies would use in order to boost their profit potential. The first one we are saying is differentiation. In differentiation, using the example of KCB can come up with products or services that are unique to the bank. They could offer internet banking. They could come up with a mobile app for easy access of loans. They could also come with what you can say corporate banking services. They could also come up with say, these are for corporate clients. They could also come with an investment banking service application. This is unique to KCB. If you look at the other players, say for example, we look at maybe a bank like Cooperative Bank, for example, yes, they may have internet banking. Yes, they may also have a mobile app. They may also have corporate banking, but even if they have investment banking services, they do not have an investment banking app where investors can be able to trade or buy and sell shares at the convenience of their mobile phones. That is what I'm saying is differentiation. The products from KCB might be differentiated from Cooperative Bank or might be differentiated from National Bank or even Equity Bank. So we can put that down and say that is how a company differentiates its products. Or services from its competitors. So one of the ways that Michael Porter had proposed is that a company can differentiate its products or services from the other members to try and boost the profit potential. Number two, There was differentiation. This other one is cost leadership. Now, using the same example, KCB, maybe it's now, instead of using maybe Cooperative Bank, I could use Equity Bank. KCB, in terms of cost of accessing their services, might be quite high as compared to Equity Bank services. Why? Because Equity Bank has come up with a cost leadership strategy that offers financial, or that provides financial inclusion, or that provides financial services to the middle and the lower income earning population, or people who live slightly above the poverty line or slightly below the poverty line there. So that is it for Equity Bank. I also have an account with Equity Bank. It doesn't mean that the poverty line is actually there, but it's because of how they have differentiated their products from KCB. I prefer to have KCB because Equity Bank, because Equity Bank has got that, provides that convenience through the mobile banking app. So do KCB, but I find the mobile application being more user friendly like that. In terms of costs of how you can be able to access financial products, you using, say, Equitel, it's much cheaper as compared to the one that is being offered by KCB. Access to loans for KCB. However, KCB have also partnered with Safaricom, where they come up with KCB M-Pesa products. But in terms of the cost and the convenience, you might find that Equity Bank has an edge there. So we can put that in writing and say, refers to how a company provides its products stroke services at a low cost than its competitors. Number 3, we have focus. Now, Michael Porter said you could either become differentiated, you could come up with products which are differentiated from the market, or you could become a cost leadership. Under focus, you could either concentrate on one of these two. So you focus on either being differentiated or providing differentiated products, or you become the lowest cost leader. Refers to companies either focusing on one strategy, brackets mentioned above, and concentrating the company's objectives to the achievement of corporate strategy. There. So you either focus on differentiation or you focus on being the lowest cost producer of goods and services. Now that is understanding the business. We try and conduct an industry analysis, and now we're saying that we also need to move ahead and focus on generic strategies that companies would use to boost their profit potential. What we're saying could be a company analysis. Differentiation, focus, cost leadership. So as far as our summary here, or our abridged summary is conducted, we have actually done understanding the business. Now we will focus on forecasting company performance, which is the second step in the equity valuation process. forecasting. 2, company performance. Under forecasting of company performance, you or an analyst stroke investor will now concentrate on either a top-down approach or a bottom-up approach when forecasting company performance. So we will have number 1, top-down approach, forecasting company performance. So we have economy, industry, company, analysis. Yeah. The economy-wide factors refer to the macroeconomic factors, including GDP, inflation, interest rates, exchange rates, and so on and so forth. The industry factors refer now to the Michael Porter's, the 5 forces of analysis which we've actually looked at. The industry analysis, we say Porter's 5 forces analysis. Yeah. And then the company analysis looks at analyzing the company's financial statements. Top-down approach, as the name implies, you start by analyzing the economy-wide factors, then you move to the industry factors and finalize by looking at the company specific factors. Using the example of KCB, you can be able to analyze the general economic performance of the country, of say Kenya, for example. You analyze the per capita GDP, you look at the inflation levels, you look at the interest rate levels, the inflation risk, you also look at the political risk, such like factors. Those are what you're saying are the macro factors, which are economy-wide factors there. You come down now and analyze the industry. We've already done an industry analysis using the Porter's 5 force analysis. We started with the competitors, and we looked at the buyers, suppliers, substitutes, and the new entrants there. After doing that, now you analyze the company's specifics based on the financial statement. So you pick the annual report and analyze it. At least a 5-year review needs to be conducted when trying to look at a company analysis. 5 years. So from 2017, you need to look 5 years back. You read the annual reports and try and get meaningful conclusions from the chairman's statement as well as the mission statement from KCB, and try and link it with the overall strategy of KCB or the overall objective of KCB there. So that is a top-down approach, just as it looks. Economy-wide factors, industry factors, and company specific factors. Now, I'm sure that the bottom-up approach can be also ensued. You can be able to ensue something from the bottom-up approach. We still pick those factors, 3 factors: economy, industry, and company analysis. And then now we look at it now from the opposite direction. So you look at economy, industry, and company. So those variables are now looked at the opposite direction, moving like that. That is what we're saying is a bottom-up approach. So we can probably squeeze in something here. I can rewrite it again. Bottom-up, number 2, bottom-up. Bottom-up approach. So we have the economy, industry, company. Just draw an arrow like that. So we are saying we can be able to write the factors GDP, inflation, interest rates, like that. Then the industry, Porter's 5 forces analysis. Then we look at the company specific financial statements. And we talk about financial statements, we're talking about the three major financial statements: the statement of comprehensive income, the statement of financial position, and the statement of cash flows. So once we have looked at forecasting company performance, this is how you can be able to generally be able to forecast the company performance based on a top-down approach and the bottom-up approach. This concludes our lesson 3 for the equity valuation process. We hope that you can be able to join us in our next lesson as we conclude this major topic of equity valuation process. Thank you and God bless you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.